So thank you all for being here today. I wish we could see each other in person, but these are the circumstances that we're dealt with, and we'll make the best of it. I wanna start sharing some statistics about the financial burden of cancer because it's it's very real. So according to Family Reach, nearly 3/4 of adult patients experience some form of financial burden related to their cancer diagnosis. So that's the majority of cancer patients. Further, on top of that, nearly 1/3 discontinue working full time during the cancer diagnosis. The financial burden of cancer is very real. If you did a quick Google search, there's even a term out there referred to as financial toxicity related to cancer. So it's my hope today that I can help educate you and empower you as you go along and make good financial decisions, as you continue on your journey with your cancer diagnosis. And I hope you can walk away with some great information and excited to be a part of this. I want to start out and I want you to think a little bit about what your financial life might look like. And for some of us, maybe we've already thought about that a little bit, but I want you to really think kind of long and hard about what the different components could be. For some of us, we may have self-pay assets, maybe IRAs, maybe pension plans, maybe emergency savings that we've spent time saving up. Maybe we own a home and we have equity in our home. Many of us also have some form of insurance as well, health insurance, maybe life insurance, disability insurance. There's long-term care insurance that can also come into play. There's also government resources, Medicare, Medicaid, Social Security, if you're a veteran, veterans benefits. And maybe some of us even have some individual support as well, maybe family, friends that are providing some form of support, maybe charitable organizations, fundraisers, or even crowdfunding also as a resource. But when we start to think about our financial lives, it can increasingly get to be really quite complex. It can be quite broad. And there's a lot of moving parts. And different parts of our financial lives can have impacts on different areas. So as you go through and you're making financial decisions related to your cancer diagnosis, I highly encourage you to work with different professionals and different experts in these different areas. Work with the social workers, work with an accountant to understand tax consequences. Work with an attorney where legal matters are involved, and consider working with a trusted financial advocate and planner as you try to make good financial decisions. Now, we think about our financial lives, and maybe we realize that it's a little bit more complex than what we think. You throw in then a breast cancer diagnosis, and all of a sudden these challenges, this financial situations becomes even more complex. And it's likely that some of those financial goals that you had pre-cancer are probably still there. You may still be thinking about retirement, or you may still be thinking about saving for education for children or grandchildren, or maybe there's certain legal matters or budgeting, kind of some of those traditional financial planning topics, and that's likely not going away. But now you throw into the mix with the cancer diagnosis some immediate needs that also pop up. And you're all of a sudden starting to try to balance current versus these, future, other financial planning items. Maybe you've lost wages. Maybe you've had to step away from work. Maybe a spouse has needed to step away from work to help. Maybe you're trying to coordinate insurance or understand various benefits, look at Social Security. Maybe you're thinking of, survivor planning. But it really is a balancing act when it comes to a cancer diagnosis. So one of the best things I think you can do, as we've kind of highlighted some of the complexities, related to our financial lives, and especially with a cancer diagnosis, I highly encourage you to find a financial advocate. I know there are financial advocates. I know Linda works with financial advocates. It could also be, you could also have a financial advocate that's a family member or a friend or a trusted third party. but find that advocate for you, someone that's going to be on your side, someone that's on your side of the court, really advocating for your best interests. And, like a healthcare advocate, sometimes too, going into a doctor's office and hearing about all these different things, it's hard to keep them all straight. Same applies for finances. Sometimes two heads are better than one, and you can make sure you're asking all the appropriate questions, taking down the appropriate notes. And together you form that team that's going to ensure, a successful, transition with your finances as you continue to navigate your cancer diagnosis. So I want to touch on a few things today, and actually going to jump around a little bit. I've done some volunteering in the cancer space with Family Reach, and have had some cancer patients of my own as clients. And I've kind of come across some common themes that I want to bring up and just share with all of you today. And my hope is that you don't walk away an expert, because I'm not expecting that, and we just don't have enough time to make everybody experts in these topics. But my hope is that I can, inform you about these areas, get you thinking about these areas so that you can maybe do some more research, ask the appropriate questions, or really know, where to look or what to think about as you go forward. So this presentation is intended as a very high-level overview. It's really hard to, everyone's situation is so different. It's hard to nail in spot on and cover all the unique situations out there. But I'm hopeful that you can walk away at least with some good information today. And I know Linda's got some great information of hers to share as well. So I want to start with, what if you're diagnosed with cancer and you're not retired yet? What if you're still, working? It's pre-retirement, and what if you've exhausted some of your financial resources? What if you need to access retirement funds early to make ends meet? How do we go about doing that? We're in unprecedented times. I do want to touch on the CARES Act and coronavirus relief. We still have a little bit of a window of time there with some of those relief measures. Also spend some time talking about life insurance. And I've actually been asked a question, is it possible to obtain life insurance after cancer? So I'll answer that question. We'll look at some life insurance benefits as well, as far as living benefits. And then we'll finish up with some debt relief, looking at student loans and kind of some general debt repayment strategies. And with that, then I'm going to turn it over to Linda, and then we'll finish up with some Q&A at the end. So think about questions that come up, and we'd love to be able to help answer any questions that come up along the way. Okay, so let's take a case here. Someone has a diagnosis of cancer, at the age of 45. And let's say this person does use up their savings, and they're looking to make ends meet, and they're looking at the retirement plans. Is it possible to pull out those retirement funds early, in a crisis type situation? And the answer is yes. However, often if we pull out prior to age 59 and a half, we could see a 10% penalty plus any taxes on distributions that we pull out for prior to retirement. And retirement, as defined by the IRS, is kind of that magic age of 59 and a half. Why it's 59 and a half, I'm not quite sure. I think we throw in the half to just make it a little bit more complex, but 59 and a half is kind of that IRS defined age. Any distributions prior to that, we potentially run into the risk of that additional 10% penalty. However, there are always exceptions to the rule. And I want to spend some time talking about some of the exceptions that exist out there. And when we think about retirement savings, there are generally kind of two different routes you can go for retirement savings at a high level. You have your employer retirement plans, which would be like a 401k, a 403b. And then also you have, your individual retirement savings as well. I would define that as like an IRA or a Roth IRA, a simple IRA, something like that. I want to first focus though on the employer retirement plan, because the rules here are going to be unique when comparing them to an IRA. And with an employer retirement plan, they tend to be a little bit more restrictive as far as the ability to be able to access monies. So if you needed to access your retirement monies as kind of a last resort in an emergency, there are 3 general ways to access. Number one, if you were to separate from your employer or to become totally and permanently disabled, you could access those monies. Whether or not those monies are subject to that additional 10% penalty, we'll talk about in just a moment. Number 2, there's something called a hardship distribution. And a hardship distribution is something that's written in the retirement plan documents that allows for an immediate, or that grants permission to pull these monies out for an immediate and heavy financial need. And it's an amount limited to an amount necessary to satisfy that need. Again, whether or not that's subject to that 10% penalty depends on whether or not these exceptions are made. Also, every plan is unique. So further adding complexity, to the rules, each employer retirement plan is unique. So you have to understand the unique options of your plan. And what I'm saying here is generally speaking, but ask your plan administrator to understand the rules of your plan and see what those rules allow for. Now, there's also something a little bit different called, like a retirement plan loan. And that's actually exactly as it sounds. You're actually taking your retirement plan loan and you're lending yourself money from your retirement plan balance. And you could actually lend up to 50% of your vested balance or $50,000, whichever is less. Now that is not going to be taxable as long as you continue to remain employed. If you were to separate, you could have, we could see some tax consequences come into play that as that loan comes due. And also, as long as you continue to repay that loan according to the repayment schedule, you want to make sure you continue to, work with the agreed upon repayment schedule to keep everything in order. So I want to focus on these other 2 items to the right: the separation, from your employer, or a hardship distribution, and whether or not monies would qualify for an exception. And you can see here on the far right-hand side, I've kind of grouped things into some broad areas. So, let's look at situations where, taxes would be owed. It's hard to get around that. If these are pre-tax monies, you're going to likely owe, you're going to owe taxes. But let's look at exceptions to that 10% penalty. And I'm just going to kind of go down one by one and share those exceptions. So number 1, if you had medical expenses over and above 7.5% of your adjusted gross income, those medical expenses you could cover those medical expenses without that 10% penalty. If you were considered totally and permanently disabled, you could avoid that 10% penalty. If you were to take substantially equal payments, now what that means is if you were to separate from your employer and you were to take recurring distributions from your retirement plan and spread that out over your life according to this distribution schedule, and it gets complex, you'd want to work with an accountant here, but you can actually avoid the 10% penalty. We also call those 72T payments. There's also sometimes in the plan documents, some plans will allow for separation from service between the ages of 55 and 59 and a half. And you can actually pull monies out without that 10% penalty if you retire during or after age 55. And actually as early as age 50 for certain public safety employees. So again, look at those, talk to your plan administrator, understand the rules. The plan document that really outlines these rules is called a summary plan description. You could usually request that too from your plan administrator to get that document and to do some research there. Now, some of you may have 457 non-qualified plans. Those are non-qualified plans. You can pull those out without penalty. And new with the relatively recent Secure Act, for qualified birth or adoption up to $5,000 per year, you can avoid that 10% penalty as well. So we talked about the situation, no taxes, no penalty, as long as all the rules are followed, as long as you're still employed, that would be the retirement plan loan. And generally speaking, anything else would be subject to taxes and 10% penalty. Now, there's all sorts of cases out there, but generally speaking, that's going to be the case. So I want to talk a little bit about IRAs because some of you may have, individual retirement accounts as well. An IRA, a Roth IRA, a SEP, or a simple. And the rules here are a little bit different. They're a little bit more flexible than an employer retirement plan. These are monies that you've stocked away for your own retirement. And money can be withdrawn actually at any time. Now, whether or not those monies can be penalized, again, depends on exceptions. So you'll notice some of these exceptions are the same as what they were for distributions from an employer retirement plan. So again, we see medical expenses, we see total and permanent disability, we see those substantially equal payments. But this is unique to IRAs. If you are paying health insurance premiums while unemployed from your IRA, you could avoid the 10% penalty with those distributions. If you're a qualified first-time home buyer up to $10,000, you could avoid that 10% penalty. If there's higher education costs, you can pull out, again, avoid that 10% penalty. And we also see that the qualified birth and adoption relief is also there up to $5,000 per year and avoiding that penalty as well. Now, as far as no taxes and no penalties, there is, with a Roth IRA, it's treated a little bit differently than a pre-tax IRA or a traditional IRA. So with a Roth IRA, which is after-tax money that's put in, meaning monies have already been taxed, monies that go into a Roth IRA, you pull out tax-free in retirement. Whereas with a traditional IRA, those monies during retirement are pre-tax, and you pull those out and you pay taxes during retirement. Now, Roth IRAs have special accounting rules, and you can actually access your basis or the contributions that you have put into the Roth IRA, and you can actually leave the earnings in the IRA, and you avoid paying taxes or penalties on your contributions that you pull out. Now, Roth conversions are another type of vehicle. They're a little bit different. So just know there's different rules with conversions, but it's a way to access some monies if needed in a pinch and avoid penalties or taxes. Generally speaking, though, anything else, you're going to see the taxes and 10% penalty when no exception applies. So, we're in unprecedented times with 2020. I want to share a little bit on coronavirus related distributions because this is pertaining to if you were to take distributions from your retirement plans. This is a provision within the CARES Act. And if you have been impacted by coronavirus, meaning you, a spouse or a dependent, has been diagnosed with COVID, or if you've experienced any adverse financial consequences. So this could be a result of quarantine, it could be a furlough, it could be a reduction of hours or pay, maybe a lack of childcare and there's financial hardship. If you've been impacted financially, you could qualify for this coronavirus related relief. And what that relief entails is that until December 30th, 2020, now whether or not that deadline gets extended, we would need lawmakers to agree with one another. So we'll see if that happens. But you can pull out up to $100,000 from all of your retirement plans and IRAs. So it's an aggregate limit of $100,000 from an eligible retirement plan. And taxes would be owed, but you can actually spread those taxes out over the course of 3 years. So even if you took all your distributions out in 2020, you wouldn't have to pay that full amount of taxes in 2020. You could spread them out over the next 3 years and minimize that tax liability. You can also avoid that 10% penalty for those coronavirus related distributions. Now, some situations you may be able to also repay if you feel like your financial situation improves and you want to replenish those retirement monies. They are actually allowing you to repay within 3 years of that distribution, and no taxes would be owed as well. So a very, very fluid situation. We're seeing lots of changes this year. So continue to be on the lookout as far as coronavirus related relief. And the IRS website is a good resource here. You can see a link to see some more questions and answers related to coronavirus distributions. Okay, so I want to shift gears now and I want to talk about life insurance after a cancer diagnosis. And I've actually, I've had a few cancer patients that have come to me and said, is it possible to get life insurance still with cancer? And it depends. The big issue is going through medical underwriting and not getting approval. But there are routes you could go and avoid that medical underwriting. So I highly encourage any of you, if you are employed or if a spouse is employed, really maximize group life insurance if offered through those employers. And a lot of times with those employers, they offer group life insurance up to a certain threshold without medical underwriting. And sometimes that actually can increase each year as well. So you want to make sure you stay on top of that. Also, consider professional associations, churches, alumni associations. Some of those groups, they also offer group benefits. You might be able to get some group life insurance coverage, and you may be able to get some life insurance without that medical underwriting piece because they're looking at the group as a whole. I also encourage you, if you have any existing life insurance policies, really think about, what do those existing policies offer? Explore those policies. Do they offer a guaranteed insurability rider where you can purchase additional insurance without medical underwriting? Do you have a permanent life insurance policy that has a cash value component? Is it paying dividends? With some of those policies that pay dividends, you can tell the policy or tell the insurance company that you want those dividends to purchase additional insurance without medical underwriting. So it's a good way to continue to build that life insurance benefit. Now, rules vary by state with insurance, and also they can also vary by insurance company, by the insurance carrier. So Wisconsin does have the Wisconsin Office of Commissioner of Insurance, and you could go on their website and search for licensed carriers in Wisconsin. And if you wanted to, you could conduct some due diligence and really kind of pick these insurance carriers' brains and understand, if you want to get life insurance, how long do you have to be out of the window of a cancer diagnosis? What are the rules? What types of cancers can you not get life insurance? That would take some legwork. There would be some legwork involved. You could also work with an independent insurance agent. They may also be able to help you quickly identify companies as well. So there's a few options there to do some further research. Now, this other point I want to point out is pure accidental death and dismemberment policy. And I've actually used this with a client who was unable to get life insurance due to medical underwriting. And they were expecting a child, newly married, and they wanted just some sort of coverage in place. So with a pure accidental death policy, it's a policy that only pays out as a result of death or related to an accident. So you avoid the medical underwriting altogether. Now, for some, it might not be worth it. You might say, well, that doesn't cover a whole lot. And the specifics can vary by policy, but for some, they might just want some form of coverage. This could be an option to consider. Now, the one point I want to leave you with, if you do have group benefits through your employer or your spouse's employer, and if you were to separate from those employers, meaning you were to leave that group, pay close attention to those insurance policies. They may allow you to carry those policies with you. They may allow you to convert those policies. Actually, my wife left her employer not too long ago. She was actually even able to carry her group disability policy with her. So really be keen and be watchful and aware of these benefits. And if you're to separate, make sure you don't lose any coverage that you don't want to lose. And often that window of time is very, very short. I've seen individuals miss that window of time and then they do lose those benefits. So something to be aware of there. Okay, I want to talk about life insurance as a benefit as well, a living benefit. And there's something that's referred to as an accelerated death benefit. And an accelerated death benefit is a rider within a life insurance policy, or it could be a settlement option that allows you to take a living benefit. So it allows you to take that death benefit, convert it to a living benefit while the insured is still living, depending on if certain criteria are met. So often that criteria means there has to be either maybe a terminal diagnosis, a catastrophic diagnosis, or a chronic health diagnosis. So you'll want to understand, the definition within the policy. And I have used this with clients as well. And in this example, we have, let's just say a $500,000 death benefit. In this case, let's say there's a cancer diagnosis, and they meet the definition for this accelerated death benefit, and they advance and take a living benefit of $350,000, or 70% in this case. That remaining 30%, or $150,000, gets paid out to the beneficiary at death. Now, that benefit is generally not taxable as long as criteria are met. However, we really need to think about, what is a death benefit meant for? And a lot of times it's meant to protect your survivor, to improve, to, in the event of death, help your survivor overcome any financial difficulties. So, getting a lump sum can certainly help relieve financial difficulties, but what you don't want to have happen is, you don't want to spend that money on, discretionary items, and then have no money left for the survivor, and then they're in a pinch, down the road. So you want to be mindful of that. And where I've seen it really come into good use is, if you take this lump sum and you pay off maybe if you look at your debts, relieve some of these debts, improve your cash flow, and just give yourself some flexibility, while battling your cancer diagnosis. So it is an option that's out there, but lots of things to think about there. Now, not all policies offer an accelerated death benefit. And in those cases, you could consider what's called a viatical settlement. And a viatical settlement is, in concept, in theory, similar to an accelerated death benefit. However, in this case, you're actually selling the life insurance policy to a third party. That third party becomes the new owner of the policy. They're going to pay premiums. They're also going to collect that death benefit when the insured passes. In return for that, though, they are going to pay a lump sum. It's going to generally be less than the death benefit to the insured while they're living. Now, this is a pretty complex area. You really, really want to work with an expert, understand the legal, tax, and financial consequences to making a viatical settlement. So there's research that needs to be done here, and you just want to be cautious. Know what sort of decisions you're making, understand the consequences. But it is something that's out there. Now, if you had to pick between an accelerated death benefit, if it's an option, and a viatical settlement, generally that accelerated death benefit is going to be more advantageous as far as from a life insurance standpoint. All right, I want to shift gears and kind of bounce on over to talk about debts a little bit. And I want to spend some time talking about student loan debt. And I actually worked with a cancer patient. She had a rare cancer diagnosis. She was young. She was also a veteran and had a service-connected disability. And she had these student loans that were outstanding. And I helped her with looking into a total and permanent disability discharge, where, as long as she, met the criteria, she could see her student loans discharged and relief of that debt. And that discharge would not be taxable for federal tax purposes. Now, state taxes can vary, so you want to make sure you work with an accountant to understand the consequences. And there is a discharge monitoring period as well to be mindful of. But it could be a really excellent form of relief and reduction of debt if you meet the circumstances. So, one option would be if you're a veteran, you have a service-connected disability, you're disabled, you could potentially qualify. If you're receiving Social Security disability or supplemental security income, and your review period for that disability is within 5 to 7 years, you could potentially qualify. Or if you've been certified by a doctor, a physician, that you're totally and permanently disabled, you could also qualify. Now, if you don't qualify, know that at death, generally federal student loans are discharged. Private loans may vary. So just keep that in mind with federal loans as well. If you don't qualify for a discharge, there's still other relief measures out there. And as of 2018, repayment of certain federal student loans can actually be deferred while you're undergoing active treatment for cancer. And actually, you could even defer up to 6 months after that active treatment is completed as well. So if cash flow is tight, this could be really a way to improve that cash flow while you're going through this crisis situation, while you're dealing with your cancer diagnosis. So a few options that are out there. Again, work with a financial planner, work with an accountant. Understand the consequences if you were to utilize these. Understand the ramifications that they have in your situation. Now, before I turn it over to Linda, I want to finish up with one more item on my end, and I want to talk about debt repayment, kind of just at a general level right here. And there are, generally speaking, there are two types of debts. There's secured debt, which is going to be secured by a piece of collateral. So it could be a mortgage, could be a home equity loan, it could be a car loan. Because it's secured by collateral, there's less risk to the lender, and generally they pay lower. There's lower interest rates. However, if you're unable to pay these secured debts, collateral could potentially be lost and credit impacted. So there could be some pretty significant consequences you want to avoid with secured debt. Now, there's also unsecured debt. That would be credit cards, medical bills, student loans, personal loans. And often these debts aren't secured by collateral. And because they're not secured by collateral, there's more risk to the lender. And generally, to compensate for that risk, they charge higher interest rates. If unable to pay those debts, you could see your credit impact. You could see lawsuits to be filed. Now, if you were to accumulate debt, which is common with a cancer diagnosis, especially as you go through, a crisis situation and you experience the financial burden of cancer, if you get to a point where you want to begin to repay debts, how do you approach it? Because it could often be overwhelming. And, I think first things first, working with your financial advocates, working with Linda, working with a trusted financial planner, it's important to understand the different options available. But if you're at a point where you can start to think about repaying, continue for sure to repay the minimum payments on all your debts. But I highly encourage you, build a budget, understand on paper what your cash flow looks like. If you have excess cash flow, start thinking about how can you start to pay off some of these debts. And, you could take a couple different strategies. You could pay your smallest debts first, build that momentum. You could also, kind of conventional wisdom, pay the debts that have the highest cost, pay the highest interest rates first. I think either of these strategies are good. The most important thing is to get in that debt repayment mode. So I don't think one's better than the other. It's just paying off that debt, repaying that debt is key. So I wanted to leave you with kind of those general thoughts. I hope this section was helpful. And I know Linda has some great information to share too from some different perspectives. So I'm going to turn it over to Linda.
All right. Thank you, Jay. That was wonderful. So as I mentioned, my name is Linda. I work for Columbia St. Mary's, and right about now, you're probably feeling a little overwhelmed and thinking about, what if I haven't been able to save, or what if I've had to already go through my savings? And I just want to kind of interject this thought, so we'll go to the next slide, is that this is what Jay and I are here for. We really wish we could give you that huge amount of money, but maybe we just give you that hug right now as we all are in this together and trying to work through this. So really, as Jay had mentioned, we are definitely aware of the financial impact of a cancer diagnosis, and the newest side effect of a cancer diagnosis is financial toxicity, and truly that's why we're here and here to help you through that. Next slide. So one of the ways that you really can focus on how can I get through this is maximizing your health insurance. You've been handed a bad diagnosis. We truly understand metastatic breast cancer. But as we look to how are we going to be able to manage our costs while we're going through this treatment, and one of the ways is being able to shift as much of that onto your health insurance as possible. So knowing your out-of-pocket costs with your health insurance plan is really important. Using in-network providers in your insurance plan, knowing your deductibles, your out-of-pocket maximum. Right now, we are in an open enrollment, and many employers for private health insurance are opening their enrollments at this time. Review your coverage and know if there's the opportunity to be able to switch into a different level of coverage and be able to maximize that health insurance coverage for your treatments. Know your prescription coverage. As you're seeing, many of the new treatments for all types of cancer diagnosis are moving into the oral medications. So having prescription coverage and looking at the different variables related to that coverage may be a way of being able to maximize it. When you're getting those explanation of benefits, please read those explanation of benefits that you're getting from your health insurance on how they're applying your insurance coverage. This is truly important, and a lot of times I'm sitting down, as well as our financial advocates, sitting down with patients and helping them understand how their insurance coverage is being applied to make sure that there aren't erroneous charges, being put through, or maybe there was a prior authorization that fell through and you're being saddled with a bill that really shouldn't be yours, and helping you appeal those decisions. Another thought, and I know that this can be somewhat controversial, but becoming more involved in your treatment plan with your physician and asking, is this truly necessary right now? Here we are in October, and maybe all of you have met your deductibles for the year and your out-of-pocket maximums. And truly it makes sense to get that CT scan in before the end of the year. Don't be afraid to ask the physician, if they're saying, we're going to put this out for 3 months, is it possible we could look at it in 2 months? Or maybe you haven't met that out of pocket this year, and maybe you want to push it into next year. You certainly can ask that, whether I can delay this to the start of next year, knowing that I'm going to have more costs related, and then again, maximizing your insurance coverage. Down on the bottom of the slide here, I mentioned the organization Triage Cancer, and Jay and I have used this program a lot when we work with cancer patients. They have wonderful, helpful videos that explain Medicare, Medicaid, Medigap insurance, Medicare Advantage plans, all of those. They have wonderful opportunities. I really encourage you to go to their website. We want to go back a slide, I think. Oh, no, we're good. I'm sorry, go ahead. So when you meet with a financial advocate or an oncology social worker, really what we're going to look at is, are there cancer-specific resources that we can connect you with? Like the Komen Breast Assistance Fund. As you're going through this, know that you can reapply for that every year as long as you continue to meet that criteria. Right now they're offering a $500 $500 assistance to be able to help with medical bills. And depending upon where you are in your treatment, it might be able to help with other costs related to your home bills. Another source is Pink Ribbon Riders. This is an organization out of Battle Creek, Michigan, but they are helping residents of Wisconsin, and they are offering a $500 Visa gift card, which can be used for medical bills. It can be used for home bills like car payments. They do have open and closed periods of enrollment, but going to their website and signing up for notifications, if you're currently in treatment, that might be another avenue of support. Cancer Care Incorporated is a program out of New York, and they are a national program that help women with breast cancer with transportation or childcare or lymphedema supplies. Again, a lot of these funds have been impacted by the coronavirus, but they are still trying to do fundraising, and they may have open and closed periods. Cancer Care also has a Cancer Care copay assistance program for helping with medical costs as well as medication costs. Needy Meds Needy Meds and Cancer Financial Assistance Coalition are two websites that are really search engines for being able to, find out, based on diagnosis, based on your location, state of Wisconsin, all the way down to Milwaukee County, being able to see if there are different avenues for financial assistance, not only from health insurance, but maybe food, shelter costs, things like that. And then I also listed college scholarships. Sometimes we're not able to, reduce the costs that you have related to your treatments, but maybe your diagnosis is something that could work to facilitate someone else in your family and being able to access other resources, which will help reduce the financial burden on you. Okay. And then another way that we help as social workers and financial advocates here at the hospital is accessing those local, county, and state resources. I mentioned utility bills. A lot of people aren't aware, if you are facing having your lights turned off because of not being able to pay a bill, you may be able to get a 21-day extension. It's considered a medical extension, so it does require your physician filling out a form and certifying your diagnosis, but it will give you that 21-day extension to avoid having your electricity turned off. Which will hopefully be able to give you time. It doesn't remove the debt, but at least gives you more time to plan for it. And again, looking at some of those options that Jay talked about. We look at medical bills, referring you to the Medigap helpline or to the local Medicaid office with a breast cancer diagnosis. And if you have lost your job and you're facing losing or maybe have lost your health insurance or can't afford the COBRA to continue your health insurance through your previous employer, you may be eligible for the Well Women program, which then gives you access to the Well Women Medicaid program. And having a breast cancer diagnosis is one portal to be able to access Medicaid coverage. Another is the MAP program, which is the Medicaid Purchase Plan. Again, these are our state and local resources that we would get you connected through. In meeting with a hospital financial advocate, please ask about whether there is hospital-based financial assistance. Some of the Ascension hospitals and other hospitals across the area have different funds that not only could they potentially help with medical bills, but they might be able to help with gas cards or food cards or being able to refer you to other types of assistance. And again, it's don't be afraid to ask. Maybe you won't be able to qualify, I know in the Ascension program, for 100% debt relief for your medical bills, but you might be able to qualify for a 70, 80, or 90% discount of that medical out-of-pocket costs, and that can be huge. Looking at children's needs, we look to see if we can connect them with Toys for Tots. That's a time that comes up now, or a family meal for Thanksgiving, or through the Goodwill Cares program, offering clothing or toys or things like that. St. Vincent de Paul could potentially help with emergency shelter or being able to provide for rent or a security deposit. Scouting programs, a lot of times the scouting programs are looking for ways to support local community programs. There are scouts that do Eagle projects, and I recall one building a ramp for an individual to be able to help them out. going to churches or your faith organizations. You know, a lot of them have food banks and or have other programs that might be able to help and offset some of the costs. Pet needs are tremendous at this time. As we know during this program, it's wonderful to see all these pets getting adopted as a result of the coronavirus. But of course, along with that comes the financial impact of owning a pet. And so talking with local shelters or the cancer care program I mentioned out of New York, they actually have a fund that individuals can apply to potentially help with the costs of pet needs like food or kitty litter or things like that. Maybe you're needing durable medical equipment, and you know, a lot of those programs objects aren't covered by insurance. We talk about Medicare when we're in the, you know, looking at things for the bathroom, like you know, tub seats or things like that. They always say Medicare coverage stops at the door of the bathroom. So, you know, you may be looking at needing a raised toilet seat or something like that. Well, there are durable medical equipment loan programs. Katie's Closet out of Waukesha, they're a wonderful program that have access to all those different types of medical equipment as well as wheelchairs. They also offer adult diapers or Ensure or tube feeding products. And so a social worker can definitely help you get connected with those programs. And the two resources listed there, feel free to call them. Impact 211 is the local resource specialist to be able to help get you connected with resources in the area, as well as the Aging and Disabilities Resource Center. Okay, so we've talked about a lot, and I really want to end on just a real positive note on just how much, you know, Jay and I appreciate being able to talk to you today. This is a reflection by Nikki Banis called Stars. And it just mentions that we are stars, and we are, stars are born from chaos. They are born only after they first collapse. And my beautiful friend, when you find yourself collapsing, when you find yourself in the midst of chaos and confusion, know that it's because of a new beginning, or a new beginning is coming. Know that everything is spinning and turning inside of you in order to form your worlds that you can't even imagine yet. Everything is quietly working under the surface to bring a new light, and it will shine brighter than ever. And that's truly what Jay and I hope for you.